Welcome back. U.S. lawmakers are considering lifting the FDIC insurance cap, which currently sits at $250,000 per depositor, and that's following the collapse of Signature Bank and Silicon Valley Bank. For more on what to expect in the aftermath of the banking fallout, former FDIC chair and author of children's books Money Tales, Sheila Bair, joins us now. Sheila, always great to see you on our program here. What happens if the U.S. just gives this FDIC gives a blanket guarantee to all the uninsured deposits, which by my tally is about $7 trillion, could be financed by higher FDIC taxes, but your thoughts?
Yeah. Well, it would be quite expensive. That's a pretty dramatic expansion of the FDIC's exposure, which is about 10 trillion now, a little north of 10 trillion. So it would be expensive. I think distributionally, it would help primarily wealthier people. $250,000 is more than enough for most households. Actually, through account structuring, you can get over $1 million. Households can get over $1 million in deposit insurance. So I think the current caps are quite adequate for Main Street households. You provide unlimited guarantees. You are really providing benefits to the wealthy. It would be a lot more expensive. The FDIC has not priced the premiums that it has assessed to capitalize this deposit insurance fund, have assumed only insured deposits at $250,000. So it would be expensive distributionally. It would be skewed towards the wealthy. And, it also would impact money flows. I don't think people understand when you provide these unlimited guarantees, then that moves more money over, right? So the money market funds would probably see a lot of exodus from money funds back into insured deposits. It might hit Treasury securities too. Instead of investing in short-term Treasuries bills, investors or large depositors might assume, okay, well, it's better now to have the convenience of a bank account. I can get a nice return and unlimited guarantees. So it impacts money flows as well. And those may be good or bad, but they need to be taken into account. I think there are other ways to address this problem that do not involve universal guarantees. I chuckle a bit because there's so much wheel reinvention around this whole issue. We had this problem of uninsured deposit flight during the great financial crisis. It was hitting the smaller banks. Primarily, it's a symptom of too big to fail, which is a government, created policy that creates this perception that you're always going to be protected if you're with a big bank. So we instituted a temporary account guarantee program for transaction accounts, operational accounts. Those are the accounts that small businesses, governments, nonprofit organizations use for their daily cash management, payroll, expenses, et cetera. You really need to have those accounts inevitably go over the insured deposit limits because of their nature, but they're very important to the functioning of the real economy. So we instituted a temporary account guarantee program that was quite successful in protecting those accounts, stabilizing uninsured runs. And for whatever reason, Congress took that authority, and it was temporary. So we put it on for a while, then we took it off. And for whatever reason, Congress and Dodd-Frank decided that they didn't want the FDIC to do that anymore without approval from Congress. So now the FDIC's hands are tied unless Congress approves it. There is a fast track procedure that the president needs to request. He hasn't done so. But I think short term, to the extent we need to address this problem, that is the best solution. And it's there. It's been used. It's temporary. But again, a lot of wheel reinvention. People are overlooking what we did during the great financial crisis that was quite successful.
And in terms of where we find ourselves now, I mean, in the great financial crisis, there wasn't the pathway that the Fed is on, and quite aggressively so. Right. In the form of their interest rate policy. And Jamie Dimon in his letter saying that the U.S. banking system within this and the current disruption, most of the risks were hiding in plain sight and that we still haven't felt the full ramifications of this. What needs to take place from regulatory bodies and then in concerted better management practices from banks themselves in order for us not to see a larger ranging implication from this crisis that has ensued?
Right. Well, I thought that was a good letter. I didn't agree with all of it, but I agreed with a lot of it. And so I guess, first of all, back to the question about universal deposit insurance, the moral hazard that would create. People say, well, moral hazard, so poorly run banks could attract as much in deposits as they wanted because it's, fully guaranteed by the government. You have a lot of moral hazard. And people say, well, we can compensate for that through supervision, the examination process, the regulatory process. But as we saw, was particularly with Silicon Valley Bank you can't rely on it. Examiners are good people. They're not perfect. There's some improvements we probably can make to the examination process, but you've got to have market discipline behind it. And you've got to have bank boards and bank management on top of these risks. They're on the front line. And another thing I think that was important for what he said for the larger banks was this all-in outsized focus on these stress tests that the Fed does every year. They're increasingly irrelevant to reality. They haven't even stressed rising interest rates, which is kind of the issue right now. But they do give management a false sense of security. So we're relying too much on supervision. It's not perfect. Stakeholders, managers, boards, as well as uninsured depositors and investors need to take note. They need to wake up and be mindful of risk that are in banking, always in banking, including now in this rising interest rate environment.
And Sheila, I just want to get back to something you touched on a couple minutes ago, and that's and with regard to deposit flight, that has to do with the differences in interest rate in different accounts. And you look at the savings account rates and the deposit rates at a bank hovering below 1%, sometimes substantially below that. Then you have money market fund rates at 4.5%, sometimes even 5%. And then combined with mobile banking, what used to be sticky deposits are not necessarily sticky deposits now. How do you approach that from a macroprudential point of view and plan for something that's evolving in real time? Yeah.
Well, it can move around quite a bit. And I will say the money market funds have been benefited from implicit guarantees from the government. They've been bailed out twice by the Fed. They have massive access to the Fed's reverse repo facility, which is essentially the equivalent of a bank reserve account, paying a very nice yield to them. So they're getting all that liquidity and government backstop that banks get without any of the regulation that banks get. They don't have capital requirements. They don't have examiners going in. So I do think government is creating uneven playing fields in terms of the flow of money. And I think the Fed should address that. They should lower the rate that they pay on reverse repos. The SEC is still trying to stabilize money funds. They haven't been able to do that. But mind you, that money that goes into money market funds, most of it is government funds they're not doing private lending. They're not supporting the economy where the bank deposit would. So I do think government in itself is creating some of this movement and volatility and additional stress on banks. That said, banks need to raise their deposit rates. They absolutely do. They've been flush with cash because of all the liquidity that's been pumped into the system by the Fed, but that era is ending. So they do need to pay depositors a higher rate. And that is going to be compressing their net interest margins, but they can still charge a lot higher rate on their loans. So I think this will still work out. But you're absolutely right. There's a lot of competition in terms of the yield that's provided. And frequently depositors chase the higher yields. Now, the banks do have an advantage money market funds don't have, which is they typically have multiple relationships with their depositors. So they might have deposit accounts, they might have credit cards, they might have a car loan, a mortgage, et cetera. So that tends to make those bank deposits a little stickier. Nonetheless, banks need to start paying, and they are starting to pay higher rates on their deposits. And that, again, that's going to compress interest margins, but I don't think it'll be a big problem for most banks.
The banking turmoil that ensued at the end of Q1 was no doubt the surprise of 2023 thus far. But when you think about what other shoes could potentially drop, are there more surprises in store that you would be looking out for?
Yeah. Well, I think for the banks, longer term, there's a lot of focus on commercial real estate. Again, I think that's going to be a slow burn, which hopefully banks with their higher capital requirements and management vigilance and examiner vigilance will be able to work through that. I still think the non-bank sector, private funds in particular, are a looming risk. And there's less focus on that just because there's less transparency around it. The accounting, the public disclosures are virtually nil for these public funds, but they use a lot of leverage, and their borrowings are becoming a lot more expensive now. A lot of the folks that used to invest in them in the past are now switching to safe government securities because they're paying such higher yields. So I think there's a lot of distress in that sector, growing distress that's not as transparent, and they obviously interface with the banks. That's more of a big bank problem. They have the lending relationships, the prime brokerage relationships that they have. With the big banks, it's more of a focus there for the mega banks. But I do think there's another shoe to drop there, and we just don't know when or how bad, mainly because of the lack of transparency.
All right. We're going to be tracking that really closely, as well as the timing correlated with it. Thank you so much for joining us here today. Always a pleasure getting some of your insights. Former FDIC chair and author of Money Tales, as well as a bunch of other books as well. Sheila Bair, thanks so much for the time.
Thanks.